Thanks for joining us today on Market Call. I'm Morella Fernandez. Greg Newman on the show, Senior Wealth Advisor and Portfolio Manager at Newman Group, ScotiaMcLeod, taking your questions today on North American Equities. Here's how to reach us. 1-855-326-6266. If you'd like to dial in, you can also email questions into marketcall@bnnbloomberg.ca. Welcome. Thanks for joining us.
Great to be here.
The markets have been in a deep, deep dive since the start of the conflict in Iran. But you think this is all going to end up being benign. Why is that?
No. You know what? What I was saying in my notes was, the war, private credit, software, all these type of concerns are one thing. And I think that they are fairly benign, believe it or not, as dramatic as it looks. The part that I think the market is moving to now, the drum that it's beating to, is the inflation print that we had Wednesday morning, the PPI. I don't think the market was ready for. They're ready for this. The market is ready for the story of, okay, we have elevated oil now, and how long is that going to last, and what's that going to do for inflation? The market was not ready for Wednesday print being before the war, that we had inflation that was far too high. Like a PPI, I think of 0.8, or a strip it out on the core, it was 0.5. Too hot. So to me, that means that the rate path is not what we thought. It means that the market multiple was not what we thought. So from Wednesday to now, I think that's what you're seeing is a layer on top of that. Now, you know what? Every time you have bull markets, you always have narrative shifts. You always have tests. So everything that we're seeing now is consistent if we can get to a place where earnings growth resumes, where inflation is in check, and where interest rates do start to go down. But you know what? We're probably not going to see that for a while. Even if this war, seriously, were to get under control and the strait be open tomorrow, you'd have a rally, of course, but I still think we have these extra variables of inflation being too hot even before the war.
Okay, that being said, you do believe we will still see a bull market through this?
Well, I think that one of the reasons for the inflation was that you have tariffs, and I'm talking about the United States, right? Mm-hmm. And so those tariffs are passed through. So, and the long-term trajectory of AI is a lot of disinflation. So I do think that the disinflation story is intact past these, that tariff spike. But it does depend on how long it takes for oil to start to come down.
Okay, and we don't know what that will look like when it does, especially now that infrastructure is getting hit in the Middle East.
Right.
Okay.
Right.
All right, let's take a quick break, then we'll get to the first phone calls for Greg Newman in just a moment. Again, he's taking your questions on North American Equities. Back in 2 minutes. Stay tuned. Welcome back to Market Call. Brian is written in. He has a question about Nutrien. Is it a buy at current prices? We turn that question over to Greg. The stock has actually fallen over the past 48 hours or so by about 6%. So it did have that run up.
Yep.
Ahead of it with what's going on in Iran, what would you do right now?
Okay, so great question. I mean, yes, it had this big spike in on FERC prices, eroding confidence in fertilizer supply in the near term. And indeed, if crop prices soar, farmers are going to have a better balance sheet to buy more Nutrien, which bodes well. And the stock is not crazy priced, 16.6 times. But we think that the commodity structure for fertilizer are pricing in a conflict of 2 to 5 years, which is, way too long. So we think the commodities look overstretched. Therefore, we think Nutrien is overstretched. And, looking at the EPS path, earnings per share path over the next couple of years, looks pretty flat into 227 and into 228 in 2028. So all in, I would take a pass. I wouldn't be buying this spike.
Okay. If it dropped down, would you buy in at a lower price?
It would have to depend, but essentially, no. I think that there's better value out there right now.
Okay. Let's go on to Jim. Jim's in Elliott Lake with a question. Jim, go ahead.
Yeah, good afternoon. Greg, just wondering about Royal Bank. Yeah, we've seen a little bit of a pullback here recently, I guess, with obviously many stocks. But when you're looking at all the big banks, and I'll throw you the National Bank in there, if you, is Royal still the pick? If you had to buy one of the banks today, which one would it be?
Okay, thanks for the question. Jim, go ahead.
Jim, great question. First of all, I think, banks have relaxed capital structures that are probably coming at the end of the year in the U.S., but that's going to help all banks really, which is, great. These were M&A stories. These were improving yield curve stories. What you've seen from this conflict is the yield curve go a little more flat, and therefore NIMs aren't going to be as good. And we're talking about possibly, if this conflict lasts a long time, decelerating earnings. And what bank is the best positioned for that, combined with low volatility in trading? That is Royal Bank. Usually trades at 11% premium to the group. Right now, it's about an 8% premium to the group. So if you're going to take a stab at one of them right now, assuming that you think that this conflict's going to end soon, which I think is not the conflict ending, but the conflict ebbing down to more manageable levels, then I think you could buy the banks here, and I think Royal would be one of the best to buy.
All right, let's move on to our next caller then. Michael's in Vancouver. He's got a question. Go ahead, Michael.
Thanks, Marilla. Thanks, Greg. Greg, basically, I've taken about 15% off the table in my RIF account and put it into cash. I just wondered for your clients, are you recommending a certain short-term bond ETF or a money market fund? Where do you put excess cash for your clients? Thanks, folks. I'll hang up and listen to your response. Have yourselves a great weekend.
Thank you for the question. Great question, because a lot of people are right now pulling some money out and want to know what to do with it.
Yeah, no, I think that's a great practice. I think you want to put yourself into a position where you can be a strong hand and where you can buy when really people that have been too late to the game are selling because they kind of have to, because it's maybe threatening their night's sleep or, even their financial plan. So to put yourself in a position with your tactical ammunition, and you're doing it in the RIF account, which is great, so you don't have to pay tax on that. But, you could just go into a high interest savings account. Scotia, we have them, and they pay very competitive relative to the street. But one of the vehicles that I like is a BMO product, actually, ZST.L, which is pays a little bit more, and Steady Eddie, it's 12-month basket of rolling short-term duration investment-grade bonds, and that's probably almost as safe as cash, not quite, but with a little better yield.
Okay, that was for Michael in Vancouver. Let's go on to Derek. Then Derek's in Vancouver as well. Go ahead, Derek.
Hey, Greg. How do you like Amazon as a buy at its current price for a long-term hold? Thanks.
Okay, thank you for the question. Are you in any of the big tech at this point?
Absolutely. Listen, I think, when you have market carnage like this and everything, all the parts of your homes are getting blown down and the shutters are getting knocked off, a little bit like a hurricane, but so everything is getting attacked. I do think that the market multiple does have to maybe go down from some of the areas like banks, like industrials, but I don't think it has to happen for tech. I think tech already took its drubbing, and I think tech is the belle of the ball. And you look at Amazon; it's trading at around an 17 times 2028 PE, 20% growth rate. PEG ratio, still very reasonable. Obviously, the concerns here is that their spending is an overdrive and they're not going to get sufficient returns. I'll say that these are the smartest guys in the world. They're in a better position to know. They believe in the business, and they're at the forefront of the AI revolution. And there is this AWS spinout, which could also add another $35 per share. So yeah, I'd be buying Amazon at these levels.
Would you buy any of the others? Or do you feel the same about the others? A lot of them are spending that big CapEx money, and investors aren't seeing return or not yet seeing that return on investment that they want.
Yeah, you know what? Great question. So I would not be buying Tesla here. I would not be buying Apple here, but I would be buying Nvidia, Google, and Meta. They all, and Amazon. They all look pretty compelling right here.
All right, good to know. Let's get to an email from Sam. What is your opinion about Lululemon? Lululemon reported earnings this week. The guidance wasn't great. People are looking for a turnaround, and they want to know who's going to lead the company. So overhangs here for the company. What do you think about Lululemon?
So, I think this is a beautiful product. It's a premium brand, but I think it's still an affordable luxury. Valuation is getting much more compelling here. They beat on their Q1, but they're being impacted by tariffs. And, they do have this proxy battle with the former owner, Chip Wilson, and some other guys. And they're probably looking at, a turnaround plan where they really have to, materially reduce their stock keeping units. Now they have too much inventory. And so, it is a choppy earnings and bumpy earnings profile over the next year or two, which kind of holds me back. But at 13 times for a product as infectious as this, with a long-term track record, or penetrating customers' imaginations, I think that this is a decent bet. But remember, it's retail, and retail is very, very fickle. And from a risk-reward, there's probably better value out there right now. But it's probably worth some, I don't know how many people feel speculative right now. But if you do in your non-registered account, you can own a little bit, you can build a position, or maybe you can sell a put.
Okay, so if you are in the mood, and you're right, I don't think a lot of people are.
I don't think people are feeling in the mood right now, yeah.
Okay, let's go to Elliot in Hamilton. Go ahead, Elliot.
Good afternoon. Premium Brands seems to be doing everything correct operationally. However, the stock is falling significantly. Is this fear of weakening consumer demand, multiple contraction, and more importantly, would you start a position in the mid-80s today? Thank you.
Oh, geez, that's a great question. Okay, so is the stock cheap enough, my friend? Yeah, it's trading at 11 times 2027, and we do model decent growth. But this is what happens when you get 4 consecutive years of guidance reductions. So, I think that the street is having a problem with management and believing their guide. Now they do have ambitious targets. They just, I think, talked about yesterday on their earnings announcement that they're going to sell some non-core assets, which we think would help. And right now they have a lot of debt. 3.7 times net debt to EBITDA 2027. That's way too much debt. So I think that it's a bit of a show me story. I think that the street, and there is concern about commodities inflation here and pass through, but the stock is cheap enough. Technically, it's probably towards a range that you could be buying. But you know what? There's enough stories out there that have delivered over the last 4 years that are also cheap. So I would take a pass, all things in.
All right, let's take a quick break then. We'll line up more phone calls and emails for when we come back. For Greg Newman of Newman Group, he's taking your questions on North American Equities. Stay tuned. Welcome back to Market Call. Ryan has been holding on the line. He's in Saskatoon today. Ryan, go ahead.
Hi, Greg. My question is on Propel Holdings. Is this stock being unfairly lumped in with its peers over lending concerns? And I just had an average cost of about in the mid-20s. Just wondering if I should hold it, average down and buy more at these levels, or just sell it and move on. Thank you.
Thank you for the question. Are they being dragged down with what's going on with Go Easy, for example?
Right. So Go Easy, there was a short report that came out last September that basically said that they were doing blend and extend and doing these aggressive practices. Management came out and defended it. And, we believed what management was saying. But you had a new management team that came in there and cleaned house, and Go Easy kind of reset it. So Go Easy's probably, once bitten, twice shy, but probably on the right path here. I think Propel did get taken down unfairly here, but that, it is a whippy stock, Propel, and it's not the most widely held and is, somewhat illiquid. Delinquencies can go up in bad economies. And, we're looking at some headwinds here, and then you've got higher fuel prices. But all in, I think it's more than reflected in the stock. I think when you get into a story like this, you have to expect, like even even the stalwarts, like GE, can go huge moves, right? And the BCEs and the banks. And so stories like this can be a lot more whippy. But I do like it longer term. I think it's trading at a 6x multiple with 30% growth rate. I think the better view is just hold your nose and keep it.
All right. That was for Ryan in Saskatoon. Let's go to Anna in Toronto. Anna, go ahead.
Hi, good afternoon. I would like to take a position on Cameco. Is this a good entry point? And I'll hang up and listen. Thank you.
Yeah.
Well, everything's come down a lot. Q4, they just beat. It was well above. Their guidance was unfortunately 3% lower. Still a very attractive multi-year outlook here. I mean, the demand for uranium isn't going to stop, and these guys are your marquee players. And with the Russian guys offline for years to come, this is it. Question is the growth rate there? Yeah, the growth rate is 40% compounded annual growth rate. That 26 to 28, that's amazing. Problem is the valuation. This has been a stock that we hold. We've done really well with it. Technically, it looks like it's probably going to bounce here, but it is trading at around 70 times 2027. Price to growth, better value in other areas of the market.
Okay. Let's move on then to our next caller, Mark in Cochrane. Hi, Mark.
Hi, how are you?
Good, thanks.
Good, Greg. My question is on Allied Properties. They seem to be on the rebuild. They cut their div. It's still around 7%. Is this sustainable, and do you own it? I'll hang up and listen. Thank you very much.
Thank you for the question. What do you think about REITs right now?
Well, that's a great question. Okay, so private equity is selling off. Where's that money going? Might be going into the REITs. I like the REITs that have a more stable profile. The Crombie. I've really been into the seniors. They've been, or the retirement homes. And they've been top picks for ours a couple of years ago, and we still own them. I think that there's fair value maybe in the retail ones. The office ones have been really tough. One thing after the other, right? From COVID, and now Kuzma, and Allied. It's a good asset, but it's still got really negative growth for the next couple of years. But is it cheap enough? It's cheap enough. Would I be putting in a new position right now with a 7.3% dividend? No, I wouldn't, not yet. But somebody will make money on this by being patient, and eventually you can go in. But I think it's dead money for a while.
That was for Mark. As we move on to Kareem. Kareem's in Ajax, Ontario. Kareem, go ahead.
Hi, good afternoon. Thank you so much for taking my call. My question is on First Majestic Silver and precious metals in general. I just wanted to get Greg's opinion on if you would consider First Majestic Silver a buy or a hold at this point. Thank you so much.
Thank you for the question.
Well, the thing about gold and silver and, trying to figure out where, at what price, everybody knows the story about gold and silver, right? Everybody knows that it's a hedge to the U.S. dollar, geopolitical uncertainty, central banks are buying, they have an appetite, they go up big after shocks like the COVID and now the war. But were they priced for inflation in the system to the extent that we've seen since Wednesday? And given the fact that it might take a while to open the strait sufficiently to the point where, when is oil going to come back down? Or maybe it'll even go higher. I don't think investors in these commodities were really ready for those facts, for that inflation to be at this level. So, of course, gold falls off, and then you see silver doing the same thing. It's a tougher one. Because silver and gold, you are relying on the fickleness of investor appetite, which is a much tougher theme to play than just owning tech stocks that are changing the world, that are hinged on a great price to growth basis. So, one is kind of solve the earth utilities. The other one is trying to gauge investor demand, which is way more fickle. And so, we own silver and gold. We've owned it at way lower levels. But, when you have charts like this and you have price action like we saw in March, it's you've got to expect to have really tough days that are real gut checks.
Would you put new money in?
So, no, all things being equal, I'd rather put it into things that are more nuts and bolts that I can be more sure of in terms of the long term.
All right.
Yeah.
Let's take a quick break then. We will look at past picks from Greg when we come back. Stay tuned. Welcome back. Time for Past Pick from Greg Newman. March 28th of last year is when he chose the following pick. We're going to start with TELUS. Just T on the TSX of 2044 last March down to 1808 today, so 12% down, 3% in total return. They have that nice dividend that everybody loves, which they have now decided to make some changes, and people are worried about a dividend cut at some point.
New CEO, probably going to reset things, and good chance that dividend can get. Listen, I didn't pick this stock thinking that that wireless pricing would deteriorate further. I picked this stock for asset sales and balance sheet repair. Things really haven't yet happened, and you still got very onerous regulations here in Canada. You got this new CEO, Dodig, who could cut the dividend. I think the stock would actually rally. But I think it's a great stock. I'm down on it, but it's still really good. And I think that it's a good place for new money today. 13% earnings per share growth, 17 times 2027. Very fair to buy a yield proxy in an environment like this. And I think that's it. And I think they'll surface value and you'll get a path to growth eventually.
All right, with that new leader, let's get to your next past pick, AltaGas, ALA on the TSX. At the time, last March, it was 42.60. Today, it's up to 50.09, so 23% upside, 27% for total return. Have you held your position in AltaGas?
Oh, yeah. And this has got way more to go. I mean, picked for great value, good growth, data center growth, natural gas tailwinds linked to getting offshore, core utilities growth. All those same catalysts still exist. A little bit more expensive now, 18 times, and only growing at 11%, but still in a market like this, where you have this kind of visibility of data centers and getting nat gas offshore, great asset to own. So,
would you trim at this point just because it's had that run up?
No, because look, do I think that it's a little overbought here? And when markets come back, will this come off? Sure. How close do you want to cut the deck? If you want to be a day trader, sure, you can maybe sell a little bit. But often you miss the story. You think it's at the top, but it can go up a lot more. So would I, if I were being cute, I might sell a call on it to bring in some, premium in an environment like this. But it's a good unfolding story, and it's got more to go.
That was AltaGas. All right, let's get to your third pick from last March. Brookfield Infrastructure, BIP.UN, 42.60 at the time, now to 50.09, and that's 18% upside, and then 23% here for total return. This is one I imagine you've held onto. Why do you like infrastructure among the Brookfields?
Oh, well, infrastructure is the development and the build out of the world. And, they're involved with data as well. And they've been growing in their data operations. We picked it for its inflation-linked revenues, capital recycling, consistent organic and distribution growth, extraordinarily well done, well run. Always, to me, it's always undervalued. I mean, trades at around under 11 price to AFFO and growing at 11% with a great generous distribution that they want to boost every 5 years, every year, 5%. So good combination of growth and, good organic grower, also a continued capital recycling M&A story with a great link to inflation. So, I would still very much own this and buy this at these levels.
Brookfield Infrastructure there. We're going to take a quick break. Back in a moment with more questions for Greg. Stay tuned. Welcome back to Market Call. Charlie's been holding on the line. He's in Montreal today. Go ahead, Charlie.
Hi, thanks for taking my call. Greg, I have a position in Taiwan Semi. It's done pretty good. It's off 14% from its peak in February. And what's brewing between China and Taiwan is getting me nervous. Do you think I should get out of it before this takes a big plunge? Thanks.
Great question. Look, you know what? This is a geopolitical question. Do I think China and Taiwan is more at risk now? No, I think it's much less. I think that what the United States has shown here is that nobody has the same military equipment, really. And China, if they were thinking about taking Taiwan, they better think twice. I just don't think it's going to happen. They had another record quarter last quarter. Profit was up 35%. Robust chip demand, obviously. They upped their guide to 38% year-over-year profit growth. 19 times multiple, 17% growth rate. This is a stock that you can probably buy at these levels.
Taiwan Semiconductor there. All right. Moving on to John in Milford, Ontario. John, go ahead.
Good day, Greg. I've owned National Bank forever at $39, and with this war going on, I've just added to it again this morning. What's your thoughts going forward? Thank you very much.
That's such a great question. Okay, so you're really smart because you're not trying to play the bottom, and you're just building positions and adding. And you never know. We could go into a weekend where, it seems like all the allies are going to help. And I personally don't think this conflict is going to last. I think there's going to be resistance. There's going to be IRGC. And, you're not going to have $47 oil for a long time. But I think the strait will be copacetic within a few weeks. Copacetic where traffic is moving at a higher
one way or another, whether it's escorted traffic or reopened.
It's going to be escorted, and there's going to be boots on the ground that push. That
make that happen.
Yeah,
keep the peace.
That's right. And there's still, in spite of that, there's still going to be threats, and there's still going to be drones, and there's still going to be some hits, and that's just the new world we're going to have to live in. But will it be a lot better than today? Yes. And that would be my call. Now, do I know that for sure? No. But if that is the case, then I think banks somewhere in here are a really good buy. And if you want to buy one that's really growing really better than its peers, National Bank is a great one to be buying.
John, I hope that helps you out. We're going to Noah in Ottawa with the question. Hi, Noah.
Doing?
Noah, are you there?
Yep.
Go ahead.
My question's on Uber. I bought the stock at around $80 on the drawdown from the summer highs. It's rebounded off the low 70s. Would you be adding to the position or holding for a better entry point?
Uber just announced a deal.
Yes.
Right? They're partnering on the robo or autonomous driving situation, which could be really good for them.
Yeah, they just got a lift from that, and investors seem to be happy in a really, really tough tape. Of course, this stock has, come down from like 95 to the low 70s. And, Q4 was a beat. Ride hailing was up 19%. Delivery was up 30% year over year. It's a good story. We do like it, and it's at sober valuations. This is a tough market, though. And are there names that are slightly more attractive now, given where things have gone? I think so. But so would I buy it yet? No. But would I hold it? Absolutely. I would continue to hold it. And you can add on lower levels.
Noah, that is for you. Going on to Bill in Toronto with a question. Go ahead, Bill.
Hi. I love your show, first-time caller. I watch it whenever I can. My question is on GE Vernova. I don't have a position in it now, but it looks like it's in industry and in energy and even some software and fringes on AI. So I wonder if it's a good opportunity to jump in. I'll hang up and thank you for answering my question.
I wonder if this is in a registered account that you're going to be buying this. I wonder if you're going to be converting Canadian dollars to buy US right now. Don't know if that's going to be a headwind if the Canadian dollar can climb against the US over the next 5 to 10 years.
Would you have it in a registered account?
Yeah, in the right registered account, for sure. But I think it's a bit of a high valuation, and I wouldn't mind being in an environment like this more tilted towards the dividend story, unless I was buying, a tech play that was very soberly priced, like with a PEG ratio of close to 1, with great visibility. Now, this has great visibility, but I think the valuation has just gone insane.
651% up over 5 years.
Yeah. No, so look, I was one of the guys who was really recommending GE at the bottom. And, and then they had these spin outs, and it's made people fabulous amounts of money. Folks respect the chart, and you don't want to buy towards the top like that usually.
All right, Bill, perspective for you. I do want to make a slight correction here with past picks that we showed. The returns for AltaGas are actually as follows. Recommended at $38.99 last March from Greg, up to $48.12 today. So 23% upside and 27% for total return. So just making that correction there. We're going to take a quick break. Back to more of your phone calls in just a moment. Let's get to an email now from Pete. He says, could Greg comment on Nvidia? Thank you for the question. We mentioned it a little bit earlier. Nvidia, of course, been tracking down in this pullback and kind of range bound before that, right? It hasn't reached a high of 207, something like that, anytime recently. You like it moving forward. Would you pick it up right now where it is?
Yes. Listen, there's a lot of people, very smart people, that have memories of 2000 and the build out of fiber optics and the JDS uniphases and the other side. And, they're really asking good questions. Are we at peak demand? And I really don't think so from the buying that everybody's doing and the comments from the CEO and the way that, artificial intelligence is just changing everything. We're at the beginning of a new revolution. And look, people are really trying to figure out terminal values of software companies now, right? They're really trying to figure out, should I buy Thomson Reuters? Should I buy Constellation? When nobody can really figure out for sure which, this is a have-not world. Some companies are going to be here, some companies won't. But I'll tell you one of them that's going to be, and that's Nvidia. And you know what? You don't have to try to figure out its terminal value. Right now, it's growing at 38% and 22 times 2027. That is the belle of the ball. This is a really, really good buy. Now, look, you never know what you don't know. And, maybe demand is going to change at some point. And this is a cyclical story. There will be a time to get off, but I don't think we're there yet.
All right.
I think it's got a lot of upside still. Yeah.
Okay. That was for Pete. Let's get to John in Shawinigan Lake, Quebec. He's got a question. Go ahead, John.
My major holdings are all the oil stand stocks. I'm wondering when is time to take some profits on all of those. Suncor, CNQ, Cenovus.
Okay, fair question. We did talk a little bit about the run-up in some of the energy stocks and whether or not you would trim. You said for AltaGas you wouldn't.
That's right.
But for some of the others, would you consider it?
Well, listen, I like the Suncor story. I believe your Suncor guy, 27% earnings growth, 12 times. Look, oil prices where they are. I mean, everybody is modeling their debt and their balance sheet and their valuation and their growth rate and their production rate at $72 oil. The question is are we going to have higher than $72 oil for the year? And even if we just have $72 oil, that's a lot of balance sheet repair and a lot of return to shareholder value. So, look, I got my CNQs and I got my Suncors, and I love them here. And my call is that oil will probably come down in a month. But you know what? I could be wrong, and the valuations for these names still aren't bad. And the profile for Canadian oil versus international oil is really good, given nation building and getting out of the ground and years of underdevelopment relative to the rest of the world. So I wouldn't sell them. And yes, they'll probably sell off if everything else goes up and if our base case happens. But They're a good insurance policy, and they're still really good long-term stocks.
All right, that was John in Quebec. Let's go to Nazar in Scarborough, Ontario with the question. Hi, Nazar.
Oh, hi, Marilla. Hi, Greg. May I have your thoughts on Alimentation Couche-Tard, please? It moves to mid-80s and reverses to lows of 70s. It feels like a trading stock rather than a long-term hold. I'm looking for something for growth.
Okay.
So your thoughts would help. Thank you very much.
Thank you for the question. Let's have a look at that chart for Couche-Tard, which did report and has benefited, right, from fuel sales more recently, of course, with the upward price there.
Yep.
But also has convenience stores attached to that, which have also been doing well. But what do you think of Couche-Tard?
We like it. I mean, they just had the report, as you say, and it wasn't bad. We think that the fuel cost, I mean, the concern for the market is that fuel costs will be intolerable and there'll be less visits, and then that will hurt their store inside and same-store sales and that kind of thing. We don't think oil is high enough yet to really impact. And you know, their guidance for Q3 and Q4 was actually pretty healthy for same-store sales. So all in, it's probably not a bad value. 15 times, 24 times, 15% growth rate, 24 times PE. Less expensive than it normally is. Always a bit of an expensive stock because it is, you know, like a Costco, and you know, really good companies tend to be very expensive. But I think it's a good long-term wealth builder, and I think you can add at these levels.
All right, that was Couche-Tard. Let's go to an email from David in North Bay, Ontario. I've noticed both BN and BAM, so these are the Brookfields, coming down off recent highs. Would you consider taking a position in either stock at this time? What do you see happening in the next few months? We talked about Brookfield as part of your past picks, which has done well. Would you move into either of these Brookfield arms?
Yeah. So BAM, you know, the play there is that it's a play on lower interest rates. Well, you know, you've got higher interest rates now. It's a play on private credit to a certain extent, and private equity and fundraising and that sort of thing, which is people have taken a dimmer view on. So it's come down a lot, and it's probably got the most upside and the most torque to a reversal in those narratives. I like BN though. You know, I think the parent is very soberly priced here, and you know, benefits from, it's very diversified. It benefits from the whole story, which is infrastructure, which is renewables, which is asset management, which is even, you know, real estate starting to get a little bit better. So between the two, I think BN is the safer bet, but they're both probably good buys here.
All right, let's move on then. We have to take a quick break. We have new top picks from Greg Newman when we come back. Stay tuned for that. Join us Monday for Market Call. Jeff Parent will be with us on the show, Chief Investment Officer at Castlemore. He'll take your questions on technical analysis. That's on Monday. Let's get to some new topics from Greg Newman. We're going to start with Invesco Triple Q on the NASDAQ, Invesco Trust. What do you like about this one? I know you mentioned that it's a tech product here. What's part of that?
Okay, so first of all, I am a stock picker. So people say, you know, why are you buying an ETF? Well, you know, when I look at Nvidia, which I just said is the belle of the ball, and I think it is, but, you know, Amazon also looks beautiful here. Google looks beautiful, Meta, Microsoft. And when they're all pretty close, you know, I put pragmatism and efficiency before all else. So even though I'm a stock picker, there are times when just owning the index at the right level is a very efficient way of doing it. Plus, you've got some of these names in there like Palantir, Netflix, Crowd, Marvell that I like very much. I think the tech complex is just fine here, growing beautifully, with the most visibility at the best value, like almost trading at a regular market multiple and least impacted by higher interest rates, if that was which we have, least impacted by a weaker economy, if that's what we end up having. An area that is sobered up, PAG ratios close to 1, and utilities to our way of life and plumbing for the new economy. So very resilient earnings picture. So therefore, this is a great way. And if this is for U.S. money, don't convert to buy this. If you have Canadian dollars, buy the synthetic version of this, which is the XQQ or the ZQQ.
Okay. ZQQ. Good advice. Some people don't want to necessarily dip into the U.S. dollar. So let's get to your next pick, which is TransAlta, TA on the TSX. So electricity generation marketing as well. What do you see?
Nat gas tailwinds.
There we go.
Nat gas tailwinds. I'm looking for something that benefits from data center growth, nation building themes, natural gas tailwinds getting offshore. And if you want that right now, and I love names like Gibson, and I've been owning them, but they're right at the top, right? So this is one that's reasonably trading at a reasonable level, not near its top. Had some, issues with the last quarter that people didn't love, but we think it's, really non-events materially. This is trading at around 17 times with very sharp EPS growth, like 50, 60% over the next couple of years with a lot of data center upside that isn't even in our numbers. So I think that this is a great place to be right here and now.
It had a steep drop off last November, it looks like. Was that when you were saying it had some issues?
It had some issues with the reports, but we think that they weren't material.
All right.
Yeah.
So you'd pick it up here.
Yep.
Let's get to your next pick, which is another company that could very much benefit from infrastructure build-out. That's AtkinsRéalis.
Yeah. So, want a company that's benefiting from nation building again. This benefits from the nuclear story that is trading at a reasonable multiple with nice growth. And, Q4, what happened was they had higher losses in their construction business than people didn't like. And it's worth a charge of about 60 to 90 cents. And that caused the stock to come down. But that's like 1% of the story. Most of the story is in their engineering services. And that was in line, which was really important. Their organic growth was 5 to 7%, which is consistent with their peers. Their book-to-bill looks really, really good. Margin expansion was better than the street thought, which I think is the real key to the story at 17.3. Trading at 19 times, growing at 19%. I think very reasonable at these levels. And, hovering now around the 200 days. So good value, good price to growth, good on the chart, good long-term story. It fits. If we're going to buy, we buy this one.
Okay. Question, if it breaks to 200, are you concerned?
Oh, wow. What a great question. No, you know what? Technical analysts are always concerned. It always breaks. It always breaks a little bit. And then if it's a deeper correction, it's a different story. Usually it breaks a little bit and then it rights itself. And if my thesis is right that we have another 3 weeks at the most of peak non-visibility for this hot war and traffic starting to move better and oil prices stabilizing, then I think this is a really good buy right now.
All right, and AtkinsRéalis it is. Let's leave it there. Greg, thanks for coming in. Good to see you.
Great
and thank you very much for joining us today on Market Call. Have a good weekend. We'll see you back here on Monday.